Taking out a joint mortgage can be a great way to boost your borrowing power, but it can be a bit of a headache when it comes to working out mortgage eligibility when one of you are self-employed. Where it comes to arranging a mortgage where one of you is self-employed, it's just a case of taking that little extra care in prepping your mortgage application just to make sure you've got the best chance of success. Hi, this is Sam at Rosehill Financial Services. We help business owners and the self-employed secure their first homes and forever homes. If this is your first time watching, then do consider subscribing to the channel and we'll bring you regular content to help you in your buying journey. So first off, can you actually get a joint mortgage where one of you is self-employed? You can absolutely get a mortgage where one of you is self-employed. That being said, it's not usually as straightforward as two applicants who are employed. Employed applicants usually have more of a steady income. So assessing affordability is made very easy for lenders. They can usually just work off of the latest 3 to 6 months pay slips and a P60. Income for self-employed people has more of a tendency to fluctuate when compared to employed people. So lenders tend to ask for 2 to 3 years worth of income figures when assessing your mortgage application. So you can see where this can cause complications in comparison to an application where both applicants are employed. So how much can you borrow when one applicant is self-employed? If any of the applicants on an application are self-employed, then it's not uncommon to see one lender lend you X amount of money and another lender lend you a completely different amount of money. This is because criteria varies from lender to lender when assessing self-employed income. As mentioned already, a lot of lenders will look to average 2 to 3 years worth of your income, but there are some lenders out there that are happy to use your latest year's income. This can often help for a fairly new business or a growing business where the income is increasing year on year. And criteria differences for self-employed applicants don't stop there either. For example, for limited company business owners, most lenders out there will look to use your salary and dividend figures when assessing your income. But there are some lenders out there that will use your share of company net profits plus your salary. Using company net profits plus your salary can really help, particularly if you are a growing business and you tend to keep more money in the business. Your borrowing potential will depend on a number of factors, and this can range from your deposit to your level of income and expenditure, whether you've got any dependents, so any kids, and your credit file as well. In some circumstances, the property that you're actually looking to buy can make an impact on how much you can borrow, because it can actually limit the amount of lenders that are available to you. For this reason, I always recommend that you speak to your broker in detail about your specific circumstances. But as more of a rule of thumb, if you take your self-employed earnings and average it over the latest 2 years, then you add that to your employed partner's earnings, multiply that figure by 4.5 and it will give you a rough guidance of what you can borrow. For this example, if you're a limited company business owner, use your salary and dividend figures over the last 2 years. And if you're a sole trader, then just use your net profit from self-employment. If the latest year's income is lower, then be sure to use that income rather than an average. We're not going to go into too much detail on how much you can borrow in this video, but we have made a separate video on this, which I'll link in the description below. Again, this calculation is very rough guidance. You can actually get lenders that will lend you a little bit more than 4.5 times your income, and there are some lenders that will lend a little bit less. So again, it's best to discuss with your broker before you actually look to start looking at properties. So how big of a deposit are you going to need where one applicant is self-employed? As you will usually find, a larger deposit generally will get you more preferable interest rates. Generally speaking, at every 5% increment in your deposit, the more preferable the rates will be. However, this doesn't mean that you actually need a large deposit, even if one of you are self-employed. You can actually still buy with a 5% deposit on a joint mortgage where one of you is self-employed. So what documents are you going to need where one of you is self-employed? Well, as standard, you're generally going to need a proof of ID, a proof of address, the latest 3 to 6 months bank statements for all accounts held, and a credit report. For the self-employed applicant, you're also going to need the latest 1 to 3 years SA 302s, which are now known as tax calculations, and their corresponding tax year overviews. If you're a limited company business owner, then you're going to need your signed accounts as well. If you have a separate bank account for your business account and your personal accounts, which I do recommend by the way, then you're going to need to also provide 3 to 6 months bank statements for your business accounts. If you're a contractor, you're going to want to gather your past and current contracts and also any future contracts that you have lined up. And if you're a subcontractor paid through the construction industry scheme, then we're going to need the latest 3 to 12 months CIS payslips. For the employed applicant, you're going to want to gather the latest 3 to 6 months payslips along with 1 to 2 years P60s. We've made a more in-depth video on the documents that you're going to want to gather, which I'll link in the description below. So does the mortgage have to be in your joint names? The simple answer is no. It is possible for one of you to be on the mortgage where both of you are buying a home, but it's just got to stack up with the lender's affordability. If the mortgage is still affordable in just the employed person's name, then this can make the case a little less complicated, particularly if the self-employed applicant doesn't have a long history of self-employment. That being said, if only one of you are going to be on the mortgage, that doesn't necessarily mean that only one of you are going to be on the deeds to the property. This will be covered in the legal side of the process and will be something that you want to talk to your solicitors about. You may want to look up the ownership structures of joint tenants and tenants in common. So will you have a worse mortgage product if one of you is self-employed? Generally speaking, this isn't the case, but you might find that the self-employed applicant doesn't meet affordability or doesn't fit criteria with the lender that's offering the lowest interest rate, for example. But this doesn't mean that you're going to be stuck with a very quirky lender with ultra high interest rates just because one of you is self-employed. If you don't fit criteria with some lenders, then don't give up on the process. There are still lots of lenders out there that have different criteria when it comes to self-employed applicants. So it's good to speak with your broker and they will be able to advise you accordingly based on your specific circumstances. And at the end of the day, lenders still want to be pretty competitive with each other. So you may find that you still get a competitive mortgage product. So to summarise then, you can absolutely get a joint mortgage where one of you is self-employed. It's just a case of a little more prep work to go into it, and it's best to find a broker that knows self-employed criteria inside out, just so that you've got a bit of a smoother process. I hope you found this video useful. We do have more videos on our website and on our YouTube channel, so do consider subscribing to the channel. We also have guides that you can find on our website too. Before I let you go, I must tell you that as a mortgage is secured against your home, it may be repossessed if you don't keep up the mortgage repayments. Thanks again, and I'll see you in the next one.